The CRNA's Complete Guide to Roth Conversions. Pay less taxes in retirement. If you're a CRNA with over $500,000 in your 403b or 401k, this video could save you hundreds of thousands in retirement taxes. But most CRNAs think they can't do Roth conversions because they don't have outside money to pay the taxes. And that misunderstanding is costing their future selves. Let me start with the basics, because honestly, most CRNAs have never heard this explained clearly. A Roth conversion is simply moving money from your traditional retirement account, like your hospital's 403b, 401k, or a traditional IRA, into a Roth IRA. Think of it like this. You're not making a new contribution or adding fresh money. You're taking existing retirement dollars that you've already saved and moving them from one tax bucket to another. That's it. When you do a Roth conversion, you pay income taxes on that money today. The same taxes you would eventually pay when you withdraw it in retirement. But the key difference is, once you pay those taxes and the money lands in the Roth IRA, you will never pay taxes on that money again. Not on the growth, not on the withdrawals, not ever. So this is fundamentally different from your current traditional pre-tax 403b or 401k, where you'll pay taxes on every single dollar you withdraw, plus all the decades of growth that happened while you were working. It matters for you as a CRNA. Most CRNAs have been contributing to their hospital's 403b or 401k for years, maybe even decades. You've been getting those sweet tax deductions each year, which felt great at the time. But now you're sitting on $500,000, $800,000, maybe over $1 million in pre-tax retirement money. Unfortunately, there's a tax problem that is coming for you. When you retire and start taking this money out, every single dollar will be taxed as ordinary income. If you're married and withdraw $100,000 in a year, you could easily be paying 22% or 24% in federal taxes alone, plus state taxes in most states. So think about that for a second. You've worked hard your entire career, saved diligently, and now the government wants to take a quarter of your retirement money. That's not a small amount. We're talking about potentially hundreds of thousands of dollars over your lifetime. Let me show you the difference of using a simple visual. With traditional accounts, you get a tax deduction today. You feel good about it. You save some money on your taxes this year. But then you could end up paying significant taxes later when you actually want to use the funds. With Roth accounts, you pay the taxes now. Yes, it stings a little bit today, but then no taxes later when you use the funds. For CRNAs who expect to have substantial retirement account balances and who may be in similar or higher tax brackets in retirement, paying the tax bill now often makes tremendous financial sense. Now that you understand what a Roth conversion actually is, let's talk about why CRNAs are absolutely perfect candidates for this strategy. Many CRNAs are absolutely perfect for Roth conversions because of what we advisors like to call your income profile. Most of you earn between $150,000 to $250,000 or more during your working careers. And that puts you smack in the 22% or 24% federal tax brackets. You're making good money, but you're also getting hammered by taxes. When you retire, your income often drops significantly because you're no longer receiving that high W-2 salary. And this creates a golden opportunity. You can potentially move money from traditional accounts to Roth accounts during those lower income retirement years when you're in the 12% or even 10% tax bracket, rather than paying 22% or 24% on the same money if you converted while working. Think about that. Same money, half the tax rate. That's not just savings, that's life-changing money. Let's talk about something that's hard to admit, but absolutely real: burnout. Unlike many other professions, CRNAs frequently experience significant burnout and often retire earlier than originally planned. I know it sounds crazy to call this good news, but hear me out. Many of you leave full-time hospital work in your late 50s or early 60s, creating what tax planners call gap years between your high-earning career and when you claim Social Security at age 62 or later. These gap years are pure gold for Roth conversions because your taxable income is much lower, allowing you to convert substantial amounts at historically low tax rates. You're basically getting a discount on your future taxes because life forced you to take a break. After 20 or 30 years of contributing to hospital retirement plans, many CRNAs have $500,000 to $2 million or more in pre-tax traditional retirement accounts. Now, some financial advisors might tell you that's a good problem to have. But here's the reality. Unlike someone with modest retirement savings, you often have enough money that required minimum distributions starting at age 73 will push you into higher tax brackets whether you need the money or not. With balances this large, the potential tax savings from strategic Roth conversions can easily reach into the hundreds of thousands of dollars over your lifetime. That's serious money. I know from talking with CRNAs, most don't want to work until age 65 or 67, like traditional retirement planning assumes. You want financial independence and the option to step back from the high-stress hospital environment when you choose, not when some arbitrary retirement age says you can. Well, Roth conversions support this goal by reducing future tax obligations and creating more predictable retirement income. When you know exactly what you'll have to spend, again, because it's all tax-free, it makes it much easier to confidently leave full-time work earlier than the traditional retirement age. In many ways, you shouldn't just think about it as planning for retirement. You're planning for freedom. As a CRNA, you're not like other high-income professionals. Lawyers and doctors often work well into their 60s or even 70s. But CRNAs, you're done with the OR much earlier than that. So traditional retirement advice assumes you'll work until age 65 and then magically switch to living off of your retirement accounts. But CRNAs often have these beautiful gap years where you have some time and lower income. And it's the perfect storm for tax-efficient Roth conversions. Most advisors don't understand this pattern. They're trying to fit you into a box that wasn't made for you. So now that you understand why CRNAs are uniquely positioned to benefit from this strategy, let's talk about something that might shock you. And it's what I like to call the Social Security Tax Tsunami. When you look at the standard tax brackets, you might think that you're in the 12% bracket in retirement. You're planning your withdrawals, feeling pretty good about your tax situation. But if you're receiving Social Security benefits, which most CRNAs will be, that's not your real tax rate. Here's what actually happens, and it's a bit brutal. When you take money out of your traditional pre-tax 403b, 401k, or IRA, not only do you pay income tax on that withdrawals, but it also forces more of your Social Security benefits to become taxable. This creates what I call a tsunami of tax, because one withdrawal triggers taxes on multiple income sources simultaneously. You think you're pulling the trigger on one tax bill, but you're actually setting off a chain reaction. Let me show you what this looks like with some real numbers. Unfortunately, the relationship to income and taxes are not linear. It is exponential. And this is because of the way the American tax code is set up. Taxes increase quicker than your income. This is because the U.S. has a tiered, progressive tax system. As you make more and more money, you get taxed at higher and higher rates. It is not just the dollar amount that is higher, it's the percent that increases too. As an example, if you have $10,000 in taxable income, you pay $1,000 in federal taxes. If you have $100,000 in taxable income, you pay $13,879 in taxes. That is a tax rate of almost 14%. This is why it is advantageous to keep your income as low as possible. If larger income means triple XL taxes, well then smaller income means smaller taxes. Now here's why this hits CRNAs particularly hard. Most of you will have substantial Social Security benefits because you've had high income careers with maximum Social Security contributions for decades. You'll also have large traditional retirement account balances that will generate significant required minimum distributions, or RMDs. So this combination creates a perfect storm. The required minimum distributions will trigger substantial Social Security taxation, pushing your effective tax rates much higher than you realize. Many CRNA couples will find themselves paying effective tax rates of 25% to 30% or more on their retirement account withdrawals, even though they think they're in lower tax brackets. You're probably sitting there thinking, well, I'm retired, so I'm probably in the 12% tax bracket now. But your real rate is more than double that. As an example, let's say you're a retired CRNA couple. You need an extra $20,000 for a home renovation. So you decide to take it out of your traditional IRA. And you think, okay, this is no big deal. We're in the 12% bracket, so this will cost us $2,400 in taxes. But here's what actually happens. That $20,000 withdrawal pushes more of your Social Security benefits into the taxable category. So instead of paying $2,400 in taxes, you end up paying closer to $5,400. Your effective tax rate on that withdrawal wasn't 12%, it was 27%. You just got hit by the Social Security tax tsunami, and you didn't even see it coming. When you learn about this, your first instinct might be to think, well, I guess I should avoid taking money out of my retirement accounts. If you're going to pay 27% effective tax rates on traditional account withdrawals due to Social Security taxation, wouldn't you rather pay 22% or 24% today to avoid that higher rate later? The Social Security tsunami of tax situation doesn't make Roth conversions a bad idea. It makes them more urgent. By converting money to Roth accounts before you claim Social Security, you can avoid this tax situation entirely because Roth withdrawals don't count as income and don't trigger additional Social Security taxation. Now, I know what you're thinking. This all sounds great, but I don't have extra money sitting around to pay these conversion taxes. And that makes sense, but let's address that concern. This is the single biggest myth that prevents CRNAs from doing Roth conversions. The belief that you need money in taxable accounts or savings to pay the conversion taxes. Now, this misconception has kept thousands of CRNAs from implementing a strategy that could save them hundreds of thousands in retirement taxes. The myth usually sounds like this. I'd love to do Roth conversions, but all my money is tied up in my 403b. I don't have extra cash sitting around to pay the taxes, so I guess Roth conversions aren't for me. This thinking is not only wrong, it's actually backwards in many cases. And let me show you why. Here's the logic. If you're planning to withdraw money from your traditional IRA or 403b or 401k to live on in retirement, you're already planning to pay taxes on those withdrawals. Let's say you need $70,000 per year to cover your living expenses in retirement. Well, to get $70,000 after taxes, you'll need to withdraw about $85,000 from your traditional account, with $15,000 going to taxes and $70,000 going to you. Now, here's the key question. If it's acceptable to pay taxes from your retirement account for living expenses, why would it be unacceptable to pay taxes from the same account for a Roth conversion? I mean, the math is identical. $85,000 comes out, $15,000 goes to taxes, $70,000 accomplishes your goal, whether that goal is living expenses or a Roth conversion. Now, don't get me wrong. If you do have taxable investment accounts, it's usually better to use those to pay conversion taxes. But that's because taxable accounts are like leaky buckets. You pay taxes 3 times with taxable accounts. One is when you put money in. It's already been taxed income. 2, while the money grows, dividends and interest are taxable each year. And 3, when you take money out, you pay capital gains taxes. So because of this constant tax drag, taxable accounts grow slower than retirement accounts. So if you have taxable accounts, it makes sense to empty that leaky bucket to pay conversion taxes, leaving more money in the tax-protected Roth environment. But if you don't have taxable accounts, paying conversion taxes from the conversion itself is still mathematically sound. You're not breaking any rules. You're just being smart about timing. Let me share a real example that might sound familiar. I worked with someone who had $1.5 million in a traditional retirement account and virtually no taxable accounts. Everything was tied up in her 403b from decades of work. She thought she couldn't do Roth conversions because she didn't have outside money to pay the taxes. But here's what we discovered. Even after paying taxes from the conversion itself, she ended up with significantly more spendable money over her lifetime compared to doing nothing. Now, the key insight, she was going to pay those taxes eventually anyway. Roth conversions just let her pay it at lower rates during her gap years at, say, a 12% bracket, rather than higher rates during required minimum distributions combined with Social Security, 25 to 30% effective rates. So in many cases, paying taxes from the conversion is actually smarter than waiting, even if you do have outside money. Think about it. Every dollar you leave in traditional pre-tax accounts is going to face higher future tax rates. Every dollar you convert to Roth is done paying taxes forever. So when you use some of the conversion amount to pay the taxes, you're essentially using high tax risk dollars to eliminate future tax obligations. Now let's talk numbers. You're probably wondering, how long do I need to live for this to actually pay off? Well, let me show you how. Let's say you're a 58-year-old CRNA with $800,000 in your 403B, and you're considering converting $100,000 to a Roth IRA during your gap years when you're in the 12% tax bracket, instead of waiting until required minimum distributions push you into, say, the 22% tax bracket. Well, here's what the numbers would look like. The conversion would cost you $12,000 in taxes today, 12% of $100,000. If you wait and withdraw that same $100,000 during RMDs, it would cost you $22,000 in taxes, the 22% tax bracket. Now that's a difference of $10,000 right there. But here's the key part. That $88,000 that goes into the Roth IRA after paying the $12,000 tax will continue growing tax-free, while the $100,000 left in the traditional account will face that 22% tax rate on all future growth as well. Using conservative assumptions of a 6% annual growth rate, here's what happens. That $88,000 in the Roth account grows to about $125,000 after 6 years. The $100,000 in the traditional account grows to about $142,000 after 6 years. When you account for the 22% taxes owed on the traditional account, you're left with only about $111,000 after taxes. This means you break even in just 6 years. 6 years. And every year beyond that point represents pure tax savings. For a 58-year-old CRNA, this means benefiting from the strategy for potentially 25 or 30 years or more. That's not just savings, that could be life-changing money. And another point to consider, most CRNAs don't realize that high retirement account withdrawals can trigger substantial Medicare Part B and Part D premium surcharges. And these aren't just small fees. We're talking about an additional $3,000 to $10,000 plus per year in Medicare premiums for married couples whose income exceeds certain thresholds. What makes this particularly brutal is that these IRMA penalties are based on modified adjusted gross income from 2 years prior. So you can get hit with surprise premium increases that are nearly impossible to predict or avoid. By doing Roth conversions during lower income gap years, you reduce future required minimum distributions and potentially avoid these Medicare surcharges entirely, making the break-even period even shorter. So it's like getting a double tax break, lower income taxes and lower Medicare premiums. If you're a CRNA with substantial assets who expects to leave money to heirs, well then Roth conversions become even more powerful because you're not just optimizing for your own tax situation, you're optimizing for your beneficiaries too. Because under current law, inherited traditional pre-tax IRAs must be emptied within 10 years of your death, often forcing beneficiaries to take large distributions during their peak earning years when they're already in high tax brackets. But inherited Roth IRAs, which also must be emptied in 10 years, except all withdrawals, are tax-free. For a CRNA who expects to leave a 7-figure estate, the tax savings for the next generation can be enormous. When you factor in the estate planning benefits, the break-even analysis isn't just about your lifetime. It's now about optimizing taxes across 2 generations. This makes Roth conversions beneficial in almost every scenario where you don't need the money immediately. And another point, don't worry so much about the exact timing or the perfect scenario. I see with a lot of CRNAs, you get caught up trying to optimize for the absolute best outcome and end up paralyzed by analysis. You want to time everything perfectly and predict exactly how long you'll live and forecast future tax rates with precision. But in most cases, if you're a CRNA in good health who doesn't need to access the converted funds immediately, the break-even period is short enough that Roth conversions will provide you significant benefit. So rather than trying to predict exactly how long you'll live or what future tax rates will be, focus on this. You're reducing a known risk, which is higher taxes on traditional accounts, in exchange for taking a reasonable, calculated risk, paying taxes at today's low rates. For most CRNAs, especially when you factor in Medicare surcharges and estate planning benefits, the break-even analysis strongly favors Roth conversions. Now let's talk about how to actually make these Roth conversions happen. Once you understand the process, it's much more straightforward than most people expect. Most CRNAs are used to complex medical procedures, and Roth conversions follow a similar systematic approach. There's a proper sequence, specific forms to complete, and important timing considerations. So think of it like a medical procedure. You've got a clear protocol, you know the steps, and you execute them in the right order. The first step is the 403b or 401k rollover. This is your foundation. Most CRNAs have their retirement money in their hospital's 403b or 401k plan, which typically can't be converted directly to a Roth IRA while you're still employed. So the first step is usually rolling your 403b or 401k to a traditional IRA after you leave your hospital job. Now, this rollover is not a taxable event. You're simply moving money from one traditional pre-tax account to another traditional pre-tax account. But here's the important part. Contact your 403b or 401k plan administrator and request a direct rollover to your traditional IRA. Now, this is critical language. You want a direct rollover, not a distribution. With a direct rollover, the money goes straight from your 403b or your 401k to your IRA without you ever touching it, avoiding any tax complications or required withholdings. The second step is the IRA to Roth IRA conversion. Once your money is in a traditional IRA, you can convert any amount to a Roth IRA at any time. This is where you have maximum control and flexibility. Now, you'll work with your IRA custodian, companies like Charles Schwab, Fidelity, or Vanguard, to execute the conversion itself. And the process typically involves completing a simple form specifying how much you want to convert and when. And here's where you have options. You can convert the entire balance at once, or you can do a partial conversion over multiple years to manage your tax brackets. Many CRNAs choose to do systematic conversions, for example, converting $50,000 per year for 10 years rather than converting $500,000 all at once. The third step is a critical tax withholding decision. When you do a Roth conversion, you have two choices for paying the taxes. You can have taxes withheld from the conversion itself, or you can pay the taxes from other sources like savings accounts or current income. Here's a crucial point that many CRNAs do miss. If you're under age 59 and a half and you have taxes withheld from the conversion, that withholding amount is treated as an early withdrawal and subject to a 10% penalty. So for example, if you convert $100,000 and have $22,000 withheld for taxes, you'll owe another $2,200 in penalty on the withdrawal amount. The better approach is usually to pay the conversion taxes from other sources if possible. Or if you must use the conversion funds, make estimated tax payments separately rather than having the taxes withheld. The fourth step is understanding the paperwork. When you do a Roth conversion, you'll receive a Form 1099-R showing the distribution from your traditional IRA. And this will look scary because it shows the full conversion amount as a taxable distribution. But don't panic. This is normal. Your tax preparer will handle the proper reporting on your tax return. The conversion amount gets added to your ordinary income for the year. So if you normally earn, say, $60,000 in retirement and you do a $40,000 Roth conversion, you'll pay taxes as if you earned $100,000 that year. This is why timing and bracket management are so important. You want to stay within your target tax bracket. So the fifth step are timing considerations. And here are the timing mistakes that can cost CRNAs money. First, don't wait until December to do conversions for the current tax year. Give yourself plenty of time to process the paperwork and make any necessary or estimated tax payments. Second, be careful about doing conversions in years when you have unusual income spikes, like large bonuses or consulting income, because that might push you into even higher brackets. And third, consider the timing of other financial events. If you're planning to claim Social Security or start taking other retirement distributions, factor those into your conversion planning. The sixth step is record keeping. Finally, keep excellent records of all your conversions, including the dates and the amounts. You'll need this information for future tax planning and to properly calculate the tax-free portions of any early Roth withdrawals. So at the very least, create a simple spreadsheet or document that tracks the conversion dates, the conversion amounts, the tax year, and the taxes paid. This is essential for maximizing the benefits of your strategy. Okay, let's now talk about some common execution mistakes to avoid. Mistake number 1, trying to time the market perfectly. You'll never get the timing exactly right, and waiting for the perfect moment usually means missing good opportunities. Mistake number 2, not involving your spouse in the planning process. For married CRNAs, your spouse's income, retirement timeline, and Social Security benefits all affect the optimal conversion strategy. Mistake number 3, using the wrong professionals. Your hospital's HR department and your regular tax preparer may not have the expertise to guide sophisticated multi-year conversion strategies. Okay, last but definitely not least, let's talk about the broader implementation considerations that are unique to CRNAs. So really, it's all about timing. Successful Roth conversion strategies for CRNAs require careful timing around major career transitions. Unlike many other professions, CRNAs often have clear inflection points in their careers that will create optimal windows for this type of tax planning. The key is recognizing these windows and planning conversions around them rather than waiting until you're already in retirement. The most powerful conversion opportunities typically occur during these 3 specific periods. Number 1, the transition from full-time to part-time work. Number 2, the gap years between leaving hospital employment and claiming Social Security. Number 3, the early retirement years before required minimum distributions or RMDs begin. Let's talk about the first window, the transition from full-time to part-time work. Many CRNAs don't retire abruptly. You often transition from full-time hospital work to part-time per diem or consulting arrangements. This transition period can create an ideal tax environment for Roth conversions because your W-2 income drops significantly, but you're not yet taking large retirement account distributions. For example, a CRNA who's earning $200,000 annually might drop to $60,000 to $80,000 in part-time income, creating substantial room in lower tax brackets for conversions. The key is planning this transition strategically. Don't just stumble into part-time work. Use it as a tax planning opportunity, because this is when you can potentially convert large amounts at the 12% or maybe 22% brackets instead of waiting and paying 25% or higher later. Okay, now the second window, gap years between leaving hospital employment and claiming Social Security. Most hospital 403B and 401k plans have limited investment options and high fees. But more importantly for Roth conversion planning, they typically don't allow conversions while you're still employed. However, once you leave your hospital job, you have much more flexibility with your 403B and 401k funds. This is why many CRNAs benefit from rolling their 403B or 401k to an IRA as soon as they're eligible, even if they're not ready to do conversions immediately. Because the rollover gives you investment flexibility and conversion capability when the timing is right. Think of it as getting your money out of the hospital's restrictive system and into your control. Okay, the third window, early retirement before minimum distributions. CRNAs often have multiple income streams in retirement: Social Security, possible pension benefits, part-time work income, and retirement account withdrawals. The optimal Roth conversion strategy must account for all of these sources and their timing. For instance, If you're planning to delay Social Security until age 70 to maximize benefits, you have a much longer window for conversions at lower tax brackets. If you have a pension that will start at age 62, you need to factor in that income into your conversion planning. So the goal is to map out your entire retirement income timeline and identify the years with the lowest tax rates for conversions. Look, you're excellent at what you do in the OR, but this stuff is complex enough that you need specialists who can understand the unique career patterns of CRNAs, multi-year tax planning strategies, how to coordinate conversions with Social Security and Medicare planning, and the specific quirks of hospital retirement plans. So don't try to figure this out on your own when hundreds of thousands of dollars are potentially at stake. So that's a lot of information. Let's summarize your next steps. Here is your action plan for what to do if you're a CRNA with significant retirement savings. Number 1, map out your career transition timeline. When do you plan to reduce hours or leave full-time hospital work? Number 2, get your 403b, 401k rollover strategy in place. Even if you're not ready to convert immediately, get your money positioned for flexibility and control. 3, calculate your gap year income. What will your taxable income be during your optimal conversion window? 4, run the numbers. What's your break-even point? How much should you convert each year? 5, assemble the right team. Find professionals who understand both Roth conversions and the unique challenges that CRNAs face. You have worked too hard and saved too much money to let the government take a bigger bite than necessary. Roth conversions aren't just a nice-to-have strategy for CRNAs. They're often the difference between a comfortable retirement and a wealthy retirement. Your future self is counting on you to make this decision now, while you still have the time and opportunity to benefit from it. If you need help, please reach out to me or schedule a call directly on our website at oakcapitaladvisor.com. I can help you think through your overall financial strategy and see if Roth conversions make sense for you and your family.